Thanks for sitting down for overtime. I first want to ask you about some of the enterprise software earnings that we've seen this week. I would include Snowflake in there, C3 as well. I just finished talking to Sanjit Biswas from Samsara. There's been still some pretty strong adoption of these transformative technologies around data, AI, Internet of Things. What's the lesson there?
Well, John, thanks for having me. It's good to see you. And the lesson there on these earnings is digital transformation is just at its infancy. It's really just at the beginning. What we saw in our portfolio of roughly 25 billion of revenues in software was a difficult selling environment in Q2, an even harder selling environment in Q3, as you had all these economic headwinds. And then in Q4, you saw a pickup in the buying environment. And I think some of these public companies have been reporting similar results.
Why a pickup in Q4?
Q4 is always the spike. You do have to acknowledge that. Mm-hmm. That's kind of the buying season for the customers. And so much happens during the last week of the year, and a lot happens during the last day of the year. So usually when you forecast these businesses, even though you may have a lot of experience in doing so, you kind of don't quite forecast that spike. But the key is that we have not seen a huge drop-off like we might have seen in Q1 and Q2 of 2020, or like you saw during the financial crisis, or even when you saw years ago during the dot-com bubble burst. Customers, the key is customers are buying what they need. They may not buying a lot of futures. And now what they need as they operate their businesses, and they look to take advantage of digital transformation and become more competitive in their fields, still produces a good demand environment for these businesses.
Okay, so you're private equity, so you're building these businesses, making them more efficient. That's kind of what you're setting out to do. Here's a piece that has me scratching my head. And I'll use a couple of your companies as an example. You just got Coupa, you've got Anaplan. On paper, these are companies with the very sort of technology that everybody should be scrambling for in this kind of environment to be able to plan, to be able to manage costs. What's the go-to-market challenge for a business like that that has technology that the economy should be eating up?
John, I appreciate that. Perhaps we put you at the forefront of those companies to help us sell more software, because you're absolutely right. You think of Anaplan, the market leader in planning on the cloud, everything from the beginning of the supply chain all the way to the CFO and CEO's office. Huge ROI, huge analytics and data from that solution. And you think of Coupa, who doesn't want to lower their cost of direct and indirect procurement by using this technology? It has a phenomenal ROI for the customer. See, the challenge in enterprise software is a lot of these solutions are ahead. It's about getting customers ready to consume them.
Okay.
They do have to get their internal processes ready, et cetera. Now, it's also a challenge managing your sales force.
But what is it, just on that
productivity?
Just on that getting ready piece, what does that entail? Does that mean to already have moved certain systems to the cloud to be able to take advantage of the application on top of that, or what?
It's infrastructure, as you mentioned. It's cybersecurity. And that's why we're such big investors in cybersecurity companies. And it's also time. I mean, these companies that are buying these technologies, they have many to-dos and many sets of priorities, and they just will get to this one and the ones you mentioned at the right time for that.
So let's talk about valuations. And there was this time period, end of last year, beginning of this one, where, I mean, some might argue things are still kind of cheap, some things are, but things were especially cheap, and there was a lot of private equity activity. What are you doing or not doing now based on where we were even just a few weeks ago? Are things remaining expensive now? If you hadn't acted, did you miss a window?
We bought a lot. So hopefully we did not miss a window, and now we have to make work what we bought. And our business is we do one deal at a time. And if we see that working, then we can move forward and do others. It's so interesting because what is cheap is very hard to tell in software. Because when you look at this index of public companies, for the most part, And on average, these companies don't make money yet. We have this stat that we say that the index of publicly traded software companies that are the biggest and the best, on average, they have a negative cash flow margin. So when growth has slowed, based on the factors that we've discussed before, investors don't know how to value them on the multiple of revenue. These multiples of revenues have gone from 17 times on average at the peak to about 4 now. Now, what that does is it's much more important than valuation. Is what it does is it produces an environment where some of the highest quality, largest software companies are looking to go private because they're looking to solve for their investors and for their company the profitability issue. How do you turn these great innovators into great businesses? And they may be two different things. And one owner with one agenda has a better shot at doing that. And that's what we do in our private equity field.
Okay, so maybe a little pitch for yourself there for those who are looking to get out of the public eye and might already be public. But give me a sense of, let's take the rule of 40, for example. There's a lot more chatter about that over the last few quarters than there had been, that balance between growth and efficiency. But I see people applying that rule in different ways. What's the way? What are the real important metrics to apply when you're talking rule of 40 and that balance between growth and efficiency? How do you do it?
John, thank you for asking that. I have some pretty strong opinions on it. This rule of 40 was a financial concept that came out about 10 years ago by some hedge funds that were trying to convince some public companies that if their growth had slowed, they had to get more profitable. They couldn't compare themselves to hyper-growth software companies that may still be investing a lot of money given the life cycle of their business. The rule of 40 is just not very good. Think about it. Would you love to invest in a company that has $1 billion in annual recurring revenue and is growing at 40%, but it makes no money? Or the inverse, would you be inspired to invest in a company doing 40% cash flow margins that their growth rate is 0?
Well, doesn't it depend? Doesn't it depend on whether they have the levers to turn that one way or the other when they choose? It's about the model more than it is just about what's on the other side of the equal sign, right?
Exactly. Now, operationally, it doesn't work that way. If we could turn the lever and decide we'd rather grow at 100% a year for 10 years and invest throughout, we would do that. It doesn't work that way. What we believe in, and we have seen it, we were taught 25 years ago by some of the best operators of all time. We listened, we took notes, that's what we love. The more profitable you are in software with 90% gross margins, the faster you should grow. You have less layers of management. You have better span of control. There's so many reasons. You focus more on your core competency. You build simpler use cases that are easier to sell, easier to implement, and easier to consume by your customers. And that is the thing that investors, in our view, in general, and many operators have had this existential debate of margin versus profitability, and it really goes together.
And yet, though, I look at Okta this week. I think one of the things that was interesting about their report is it seems like their model performed better than some expected. They seem to be able to get better margins and better profitability while still having some pretty strong growth. And when you can decide, right, when to pull back and still do well, doesn't that indicate a healthy software business?
Absolutely. It does. And another sign of a healthy software business is not only pulling back, is when your investors tell you in mass, public investors are saying this finally, and they're adamant about it. You have to get really profitable, and we're going to value you on a multiple of earnings, PE, or a multiple of unlevered free cash flow, which software use is quite common. The great management teams, they get that, and they run their businesses accordingly.
All right, let's talk about generative AI. A lot of attention coming to this because of the latest version of ChatGPT out of OpenAI, and I'm starting to see a lot of velocity in companies being able to adopt this in ways that they say are going to benefit their end user. Duolingo is a great example. They not only reported some good numbers and strong growth, they said they're going to build this premium tier that allows language learning conversations based on that. They think they're going to be able to charge a premium for it, which is going to make their model look better. How are you approaching this with the companies in your portfolio?
Well, John, first, we're having a lot of fun with AI. Our associates use it. I even use it. We have a lot of fun with it. Our companies are big investors. Think about it. Enterprise software, systems of action, systems of decision-making, systems of analytics. These huge data gatherers that produce workflow software or business intelligence software, our companies have been big investors in analytical AI. Really, I mean, it's a big part of it. Now, large language models just makes, over time, the use case for these data models and these workflows more valuable. Now, it's really, really early in the enterprise. Go back to how customers can consume this. They first have to dream about how they can implement this new set of technologies, how it changes their workplace, how it changes their organizational structure, and then slowly over time, it should be additive to our space.
Are there going to be certain companies, almost like middleware, within certain industries that make this easier and faster to implement? I'm starting to see that, say, within customer service, or, you know, to again go back to the Duolingo example, there are certain things that you want to do, the way you want to structure conversation for learning, it's different from the way you want to structure it for customer service, or different than if you have the language models creating search queries that are then returning data from internal search. Are we going to see a market of just companies that sit in between there and help the customer to implement AI strategies more quickly?
Big time. We have seen that before in software, in other models and use cases, even in the old license model, with data integration systems, ETL, APIs. So that is going to be a big opportunity in this space.
Does Microsoft, with OpenAI, have any kind of significant lead over Google and others in this area?
Microsoft is just an amazing company. In enterprise software, which is our field, we don't come across Google too much, right? Their search engine is not in the market overall where we serve our customers through our companies. But Microsoft is in many cases. And they're extremely well run. They have very large market positions in many verticals, many horizontal solutions. And in many cases, they're able to bundle solutions so that they provide products that are free or are given for free to their customer. And that's a big way and a big reason why they gain market share and continue to do well. So their moves in this category are really interesting, and we'll just see.
So how much of the challenge, say, for a Google, before Thomas Kurian, the knock that I kept hearing on Google Cloud was, hey, they've got great technology, but they don't have that enterprise culture that actually helps customers and industries know how to use it, right? So they're just kind of like, here you go, figure it out. That's changed under Kurian, but how much is that the stress point of Google and Google Cloud having to prove what they can do to AI to really stand up that enterprise capability during this period?
Well, look, I'm not an expert just on them. You would really have to talk to them about it. They're just an amazing company. And I'm sure they have a different strategy that fits them and their own versus Microsoft, and we'll just see.
Okay. Shifting gears here, I want to talk about crypto. You've acknowledged mistakes with the FTX investment. I don't want to talk about those so much as about what you're doing from here. Now that there's been this sobering effect from so many of the headlines, including the most recent in the banking area around crypto, have you shifted your philosophy and approach to the kinds of investments you're making in the crypto space?
Thank you for asking that. We are a buyout firm in software. We have acquired close to 500 enterprise software companies in the last 23 years, many of them in partnership with management. Established companies where you take them private, where you keep them private. And as we say, our mission is to turn great innovators into great businesses. That is our core. Now, we have a growth equity effort as well, where we made a few investments in the crypto category. Going forward, and I said this about a year ago publicly now, that we were not going to make for the time being other crypto investments. It goes back to what I mentioned before. The way we've built our business at Thoma Bravo is one deal at a time. When we make one investment, if we feel it is going well for our investors and our community, then you can do others. And in that ecosystem, which has been very, very, very small as part of our growth equity effort, we are currently on a pause.
So even though within the fintech part of your portfolio, which might not be crypto specific, are there things that you learned from your rough crypto experience where you have different types of either blockchain technologies or others that you're pushing to have adopted in those companies to ensure their future?
It's very important as an investor and owner of companies in partnership with management to have a broad view of the past, the present, and the future. And one of the reasons we were able to get into software buyouts when we did, and we were one of the first entrants in that category when that asset class did not exist, is we were able to think a little bit differently than everybody else. Anybody else could have done it. We were lucky enough to do it by really looking at these assets with a bit of a different point of view, as big cash flow generators, as big operating opportunity, as consolidation markets with long-term growth. And yes, we have seen and learned from the space. We believe blockchain technology is going to be very important for the future. We also like the fact that having a non-government controlled store of value is a good cause and a way to transact, and in a way that has less friction is also a very worthwhile cause. We also see and continue to see a lot of young, very talented people getting into that ecosystem and coming up with use cases that maybe you could use using database technology, but it's happening there because it's attracting that kind of thought. Now, there are a whole host of issues with that space, and that's why we're taking a pause.
Finally, let's talk macro. Inflation has been stubborn. Investors have been spending a lot of time, public market investors, focused on what the Fed is or isn't going to do. How concerned are you about either what's actually happening with inflation or how rising interest rates are going to affect your companies and companies that you might look to buy?
We are concerned about that. Absolutely, right? It turns out, I think most people knew this, that with big fiscal stimulus, inflation was not going to be transitory. And with the rising interest rate environment, it's challenging for these companies that carry leverage to be able to service the ever increasing cost of debt. So it is a big concern. Now, we as investors and owners of these businesses, we can't do anything about that. We can't control it. What we can do, and we learned this so many years ago from one of the best operators of all time, is he would use this quote: "In difficult times, it is much better to be overly conservative than overly optimistic." So you see what could be ahead of you, both from a headwind in terms of potentially lower bookings than you expected and a higher cost of capital for your companies. And you have to very quickly decrease the cost base of your company so that you're not surprised. And that was something that we really engaged in the beginning of 2022 in anticipation really for the worst.
So how does that translate into how you're running your enterprise software companies differently than the competitions? I mean, you're hiring less. Does it mean you're expecting lower growth, even though you're hoping for better? What does that conservatism translate to right now?
Our conservatism is our report card, is the income statement of that company, the P&L. And by that, I mean, it's the earnings of that company. That is our report card. And we protect those earnings really no matter what. There's always a way to invest in the future. There's always a way to hire the right people. You never say no to great salespeople that are willing to join your enterprise. But that is the golden rule, is protect what we call in private equity EBITDA, or levered free cash flow. And that's your guide for how much you should be investing or waiting to invest until your customers are ready to listen to a new marketing message or a new platform or a new vision.
All right. Don't drop the bag. Orlando Bravo, thanks for the great conversation.